What are your investment goals? Have you ever considered index funds? Index funds, for those who may not know, are a type of mutual fund with a portfolio constructed to match or track the components of a market index. They are designed to provide broad market exposure, low operating expenses, and low portfolio turnover. They are, in essence, a way to invest in the overall market, rather than betting on individual stocks. According to the Motley Fool, a widely respected financial advisor, index funds are generally a less risky investment option than individual stocks. They offer the opportunity to build wealth by diversifying your portfolio while minimizing your fees. This means you're not putting all your eggs in one basket, but rather spreading your investments across a wide array of companies. So, if you're looking for a solid, long-term investment strategy that can help you achieve your financial goals, index funds might be your best bet. Ready to explore some of the best index funds for long-term investors? Let's dive in. At number 10, we have the iShares US Tech ETF. This ETF, managed by BlackRock, the world's largest asset manager, is a favorite among investors looking to tap into the growth potential of the US technology sector. It gives you exposure to some of the biggest names in technology, including Apple, Microsoft, and Google. In the past 5 years, it has consistently outperformed the broader market, making it a compelling choice for those who believe in the continued growth of tech. The iShares US Tech ETF is also known for its liquidity, with millions of shares trading hands every day. This means you can buy or sell shares at any time during market hours without significantly impacting the price. It's a great option for those who want to diversify their portfolio with technology stocks without having to pick individual companies. A potential choice for those interested in the tech industry. Coming in at number 9 is the Fidelity US Sustainability Index Fund. If you're an investor with a keen eye for sustainability, this fund is one to watch. The Fidelity US Sustainability Index Fund stands out by focusing on US companies that prioritize environmental, social, and governance criteria, or ESG. It's a great way to align your investment strategy with your values. But it's not just about the feel-good factor. This fund has also shown solid performance. It tracks the performance of the MSCI USA ESG Index, a broad index of US companies with high ESG performance relative to their sector peers. It's a diverse fund with holdings in a variety of sectors, from technology to healthcare to financials. What makes this fund unique is its commitment to sustainable investing. It's not just about returns here, it's about making a positive impact. So there you have it, the Fidelity US Sustainability Index Fund, an excellent option for the environmentally conscious investor. Next up at number 8, we have the Schwab Emerging Markets Equity ETF. This fund provides an exciting opportunity for investors looking to diversify their portfolios beyond the developed markets. The fund primarily targets companies in emerging economies, which can offer significant growth potential. While these markets can be volatile, they also present an opportunity for high returns. The Schwab Emerging Markets Equity ETF holds a broad range of stocks across many sectors, giving investors wide exposure to these burgeoning markets. However, it's essential to remember that with potential high returns comes increased risk. Followed closely by the Robo Global Robotics and Automation Index ETF at number 7, a fund focusing on the future of technology. This fund offers investors a chance to tap into the rapidly growing robotics and automation industry. It's a compelling choice for those who believe in the transformative power of technology and want to invest in its future. Halfway through our list at number 6, we have the Vanguard Russell 2000 ETF. This fund is a standout choice for those interested in gaining exposure to small-cap companies. Small-cap companies, though often overlooked, can offer significant growth potential, making this fund a valuable addition to any diverse portfolio. The Vanguard Russell 2000 ETF aims to track the performance of the Russell 2000 Index, an index comprised of 2,000 small capitalization companies. Known for its broad diversification and low expenses, this fund has consistently shown strong performance over the years. Transitioning to a completely different sector, we arrive at number 5, the Vanguard Real Estate ETF. This fund offers investors a convenient way to gain exposure to the real estate sector, which is known for its potential for steady income through dividends. By investing in this ETF, you can benefit from the growth and income potential of real estate without the need for direct property ownership. And at number 5, we have the Vanguard Real Estate ETF, a fund that offers exposure to the real estate sector. In the 4th spot, we have the SPDR S&P Dividend ETF. As its name suggests, the SPDR S&P Dividend ETF focuses on dividend-paying companies. But not just any dividend payers. It targets companies that have consistently increased their dividends over the last 2 decades. This makes it a solid choice for investors who are looking for a consistent income stream. The fund tracks the S&P High Yield Dividend Aristocrats Index. It's composed of the 50 highest dividend-yielding constituents of the stocks of the S&P Composite 1500 Index that have increased dividends every year for at least 20 years. This approach provides a degree of quality control, ensuring that the fund invests in companies with a robust track record of profitability and shareholder return. Performance-wise, the SPDR S&P Dividend ETF has proven to be a reliable choice. Over the past 10 years, it has outperformed the broader market, providing investors with both capital growth and income. Now, why should income-seeking investors consider this fund? Well, in today's low-interest rate environment, securing a steady income can be challenging. This is where the SPDR S&P Dividend ETF comes into play. It offers a higher yield than many other investment options, making it an attractive choice for income-focused investors. But, as always, it's essential to understand that past performance is not a guarantee of future results. Investors should do their due diligence and consider their risk tolerance and investment objectives before investing in this or any other fund. At number 3, we find the Vanguard Growth ETF, a fund that targets high-growth companies. The Vanguard Growth ETF is designed for investors who are looking for long-term capital growth. This fund focuses on large-cap growth stocks in sectors like technology, consumer services, and healthcare. These are companies that are expected to grow at an above-average rate compared to other market companies. The Vanguard Growth ETF offers a low-cost way to gain exposure to these high-growth segments of the market. It's a compelling choice for those who believe in the growth potential of these sectors and are willing to accept the higher volatility that often comes with growth investing. Remember, investing in growth stocks can be risky, as these companies often trade at high valuations. But for those with a long-term perspective and a tolerance for risk, the Vanguard Growth ETF could be a valuable addition to their portfolio. Almost at the top, at number 2, we have the Schwab S&P 500 Index Fund. This fund is an excellent choice for investors looking for broad market exposure. It is designed to track the S&P 500 Index, a benchmark for large-cap U.S. equities. The Schwab S&P 500 Index Fund offers exposure to a wide range of sectors, including technology, healthcare, financials, and consumer discretionary. This means it's diversified across a variety of industries and company sizes, which can help reduce risk and potentially increase returns over the long term. Performance-wise, the Schwab S&P 500 Index Fund has generally mirrored the performance of the S&P 500 itself, which has historically provided solid returns for investors. Over the past decade, the S&P 500 has averaged annual returns of around 7%, making this fund a reliable choice for steady growth. Why is this fund a staple in many portfolios? Well, it's simple. This fund provides a straightforward way to invest in the broad U.S. stock market. It's also a low-cost option, with an expense ratio that's among the lowest in the industry. This means more of your money goes towards your investments rather than fees, which can significantly impact your returns over time. And finally, at number 1, we have the Fidelity Zero Large Cap Index Fund, a fund with no expenses that targets large cap U.S. companies. The Fidelity Zero Large Cap Index Fund is unique in that it charges zero expenses. This means that every dollar you invest goes directly into your investments rather than being eaten away by fees. The fund targets large-cap U.S. companies, which are typically more stable and less risky than smaller companies. This makes it a good choice for conservative investors looking for steady growth. Performance-wise, the Fidelity Zero Large Cap Index Fund has consistently outperformed its benchmark, the Russell 1000 Index, making it a top choice for long-term investors. In conclusion, when it comes to investing in index funds, the Schwab S&P 500 Index Fund and the Fidelity Zero Large Cap Index Fund stand out as top choices, offering broad market exposure, solid performance, and low costs. Now that you've seen the top 10 ETFs index funds, what do you think? From the Fidelity Zero Large Cap Index Fund to the iShares US Tech ETF, each fund presents a unique opportunity for diversification and wealth building. Whether you're looking to venture into the expansive realm of large cap stocks or you're curious about the potential of emerging markets, These funds cater to a spectrum of investment goals. Remember, index funds offer a less risky investment avenue than individual stocks, as highlighted by the Motley Fool. They can help you build wealth, diversify your portfolio, and minimize your fees. And don't forget about the power of dollar-cost averaging, a strategy that can provide a clear path to reach your retirement goals. However, these are not one-size-fits-all solutions. Your financial journey is unique. Remember, these are only estimates, and it's always best to consult a financial advisor before making any investment decisions. Until next time.